Hey, it's Anthony and Tucker, and we came to bring you your lender update for the month of August. And let's take a look at all this fun July data because it's exciting.
Yeah, it's exciting and also eye-opening.
Eye-opening. Maybe that's a better word.
I think it's eye-opening. And really, this is coming into, we're just not in our seasonal norm right now, right? And this
Right.
is where you can really look at it, pre-COVID, forever we've had very strong seasonal market trends. And even at the beginning of this year, we had some of that, but it is not really following that trend right now. And it's, for a variety of reasons, but what you can see is, number one,
Well,
look
let's
at that
talk
green.
about the reasons,
Yeah.
right? So I think the big thing is supply is down, right?
Big time.
And supply is down, and it shouldn't be down this time seasonally, right? Seasonally, supply should adjust and increase from basically January all the way through about October, right? Slowly trickle up, and then it kind of plateaus in the summer, and then we see a little bit of a bump back in the fall when buyers tend to slow down, but listers keep listing homes. And then everything falls off a cliff in November, December when the people who didn't sell anything get frustrated and pull it off the market, right? I mean,
Yeah.
that kind of sums up seasonality as a whole. Well, what happened was we all have those lovely golden handcuffs, and we can't get out of our loans, right? Because the loan's at 3 or 4%, trading that for 7% loan takes the supply line and drops it to, well, where it is today, about 20% off of where we were a year ago.
Yep.
20% less than last month. We normally see like a 5, 10, 15% drop. I mean, it's pretty brutal, right? So
And
take a
it's-
look at this supply line. This is why.
And that's what you can see on that right side of the graph, is you can just see how fast it dropped off from June to July, which wasn't expected by anybody. But then even if we look at our month-over-month changes, we can see which areas were hit the hardest. And, we see Superior actually increased. Everywhere else in Boulder County outside of Erie had double-digit drops. Especially when we look in Boulder, we have a lot of inventory here. Then we combine Lafayette and Louisville and Superior. Lafayette and Louisville, big decline. Superior, a little bit of a jump, but that market's trying to catch back up.
But
They've been a
even look
little
at
sluggish.
Longmont, right? Longmont's 10%
Yeah.
off as well. And I think a lot of this is, keep in mind, we got a lot of cash out there in the marketplace buying. We've got a lot of first-time home buyers out there in the market buying because when they couldn't compete before, now they can, right?
Mm-hmm.
Because there's not a lot of buyers. And then where did everybody else go, right? There's
Yeah.
just not a lot of trade up. If you can afford to trade up, this is an awesome time to do it, right? There's inventory. We'll talk about that in a little bit. But the big thing is here, you just don't have enough buyers. We don't have enough sellers. And so since we actually still have buyers active and sellers really hit the pause over the 4th of July, apparently.
Yeah,
Now
big
when
time.
they pump the brakes, we actually saw a supply dip. So let's take a look at this from like a month supply perspective,
Yes,
right?
and let's just remind everyone, hey, our month supply of inventory is the ratio between what's out on the market, and if nothing else came with the current buyer demand, how many months would it take to go through all of our inventory?
Right.
And that's where we see this. We're at 2.68. So, okay, interesting, but we're about the same as we were this time last year, slightly different. And then, even more importantly, look how we've already started dropping. Normally, we would be rising
Well, I
right
don't
now.
think we're
as
going to
well.
start dropping for the rest of the season, right? I really,
Yeah.
truly think that we might plateau off, or we should still see some supply increases in August and September. July was really just an anomaly. The big thing here, though, is not all these submarkets are created equal. Look at Louisville,
Oh, yeah.
1.3 months of inventory, it's super sought after. Lafayette, 1.7 months of inventory. There's just not a lot of inventory in some of these markets. Now you get into Boulder. Boulder at its higher price points always warrants that, more inventory on the marketplace. If you compare this stuff to Denver, we're like a month of inventory more than you are in the Denver metro
Yeah.
markets, right?
So that
And
means
it's
if
largely
you-
due to price.
If you have people, shopping Denver and Boulder, it's a little bit slower. They have a little bit more time. Now, not saying you want to take all the time because you don't want to waste it, but Denver's moving a lot faster than Boulder right now just because they're even hit harder on the supply crunch for multiple weeks. It isn't a bad thing. It doesn't mark crunch than we are.
That's right. So talk about time. Here's timing. 36 days in MLS, which means just over a month to go under contract on average. That's a pretty big
That's a
jump. That's a whole
huge jump.
week more than it was last month.
Yeah. And so when you're working with your clients, what does this mean? Hey, just because something's been sitting on the market doesn't mean that there's something wrong with it. We just have lower buyer demand. So, help coach your clients. Just because it's been on the market, there's a derogatory item with that property, take a look at it, go do your showings. And that's just where you can help provide some value to your clients of, hey, this is normal. 3 weeks, 4 weeks, 5 weeks. That's kind of the norm now. for how many days on market we can
Yeah,
expect
and
houses to be.
The other thing with your buyers is depending on if they're buying detached or attached, those could be different markets.
Very.
Right now, the detached market feels pretty similar to where it was in June. Actually, it's moving quickly. You know, the list sale prices are similar, but look at this, we're only 28 days. You get over to the attached market, all of a sudden last month, the attached market just kind of paused a little bit, right?
And
now
then,
we did see some stuff that was been on the market a long time sell, so that does inflate the averages there. Look at Superior, it was at 100.
well, and this
days.
also keep this in perspective. We had some new construction, new builds that were on the market that were pre-listings, you know, before they're done. So of course those are going to take longer. That definitely skewed our Louisville and Superior stats because they have a lot of attached product either on the market or coming to market here in the next several months. So that's when they go into contract before it's finished. So that's really what we're seeing. But if we look over in Erie, geez, what's going on? That is a massive, days on market average for our attached. And that's because there's not a lot out there. And if you're going all the way to Erie, you're normally going out there to buy a house, right? We're driving to qualify.
Yeah, absolutely. All right, so let's take a look at it by price point because cost of money has really changed us by price point. We've been talking about this a lot. So anything under 800,000, it's a supply crunch problem, right? We don't have enough inventory for people to buy. Now, if we get from that 1 to 3 million range, we are just slow because money is expensive, and usually you're taking out a pretty big loan.
And these are the people who are trading up from, selling their under $800,000
houses,
and then trading up to the $1.5 million, $2 million based on their job and their equity built up. And what we see is we still see some good sales, but not nearly compared to what we have in the supply side.
I just think it's a tough pill to swallow when you want to trade up and your mortgage might rise by 3 times.
Yeah.
Right? I mean, you might have a $2,000 a month mortgage because you're holding on a 3% loan, and next thing you know, you're like, oh, I thought it was going to be like 3,000 or 4,000. Now it's 6,000.
6 or even 8,000. If you're getting into the 1.5 or even 2 million, you're looking at $8,000-$10,000 a month. There's just
even with money down.
Yeah, even with really good money down. And that just kind of brings up the question, how many people are there in that segment who can afford that and are willing to pay that?
Well, I think it's more than just can they afford it. It's more of like, are you really willing to do that?
Well, $10,000 a month in a mortgage payment is pretty tough. So
it's a tough one, right? So even if you're making a lot of money.
Yeah, it's that's a big pill to swallow. So that's one thing. But let's just look real quick here. Let me move my head. There we go.
You want to talk about 3 million, or you?
Yeah, I was gonna. Okay, there we go.
Yeah, there
we go. 3 million plus. I gotta make sure my.
So look at this. Another 17 sales this month. We are having the most unprecedented year in the ultra luxury or the high end luxury range. Here we are outperforming a year ago. Last year we outperformed the previous year. I mean, that high end market in Boulder, it's like people are just taking cash and parking it in Boulder and being like, you know what, recession's coming. Guess what? Boulder's resilient. And so what if I spend $8 million on a house?
And put this in perspective too. This is the only segment that not even is flat, but is actually up compared to last year. Everybody else is mostly double digits, except for those really low price bands where there's just barely any inventory in Boulder County.
So lots of sales. 3+ million is looking spectacular. 5+ million is like unprecedented number of sales for the last 2 years.
But it's still taking a long time to sell these houses.
Yeah, so let's look at that. You want to talk about that real quick?
Please. Thank you, Anthony. So that's where we see it right there. 11.36 months supply of inventory. That's a long time, but that's normal for a luxury market. And we can see how really cost of money is affecting this market. And you can see each price band on the top half of the left graph, how each one of them jumps quite a bit. And that's really a cost of money issue. And that's what Anthony was just talking about, that trade-up opportunity. That's a tough pill to swallow sometimes when your mortgage payment's going from $2,000 to $3,000 to $8,000 to $10,000.
Well, the big thing is, and what we're seeing a lot at Land Title is, if you can make that trade, let's just say maybe you have a loan on your $800,000 house, but maybe you got family money, maybe you have a trust fund sitting there, maybe you actually just are pretty independently wealthy, and you're like, man, there's some good deals right now at 1.2 million or 1.6 million.
It's a great
Let's
time
just write
to
a
buy.
check, right? And you're seeing it here
buy.
a lot. Or maybe, families like, we got some inheritance and we really don't necessarily need it for our retirement, so let's plug it into real estate. And people are buying some crazy stuff.
And it's at a good price for them, too.
It is
that's
a really
the
good
thing
price.
is I always like to use that word value because what is the value of your house? If you're looking at the 800,000, your value is a lot less. Where if you're looking at 9 to a million, you have a lot more value than the 800 to 900,000. So just where your value is, what you're getting for that extra 50,000 or 100,000. And then we jump into this, 1 million, 1.5 million.
1.5 to 2 million
the
range.
value you're getting.
A lot of value for those
much higher. but it's, not as many people can afford to buy it. And we've seen a lot of construction, a lot of remodels as well. So we also have more supply in these upper end, the upper end of the inventory. There's a lot more there than there has been historically, because a lot of people remodeled their homes during COVID. We're stuck inside. Let's make it ours.
That's right, and they're really nice now.
And so now we're seeing people listing those who go, oh, we don't need this house. We're back going to the office 5 days a week, or whatever it may be. That's where this inventory is coming from. So we just have a lot more in this higher end area of our market.
Yeah, so look at that 1 to 2 million range. You can see it on the days on market side here. Things have been bouncing around a lot, right? Lots of new stuff that comes to market does really well pretty quick. But if it doesn't and it sits on the market for a while, we have to start adjusting. People have this pie in the sky number. Now that we're starting to see people start to adjust to the market conditions, they may have been on the market for 100 or 200 days. Those are starting to sell some. No, I wouldn't say that's the norm, right? Average meaning average, not median. So some of those numbers have really skewed.
Medians are much lower.
Yeah, much lower. And I would say, just because the 2 to 2.5 million range last month was at 28 days, doesn't mean that like a lot of the 1.5 to 2 million or 1 to 1.5 million dollar homes are still going to 28 days, because they are.
Yeah.
Right. I just think it's important to understand. We're seeing days on market rise. It's seasonally, it's continued to trend that way. But there's a lot of stuff out there that's been sitting, and if you want to go get value or you want a deal, right? There's some of that part of the stuff in the higher end market where you could really go out and start to look.
Oh yeah, but it's
negotiate hard, right?
But it's just there's only so many people who are in that category to go buy.
Yeah, so hopefully
your
you guys are working with
competition's a lot lower. Yeah, so now's the time to go get some value and get some really good buys if they're in that bucket.
Okay, so I only want to say one thing about this. I think we have a better slide to actually really digest it, but year-to-date numbers, we're down 15% in our sold analysis. I think that's really important to understand really where we are, because
it's not as bad as some people feel. And I know
it feels and it looks worse than it really is, because 15% drop from last year. Honestly, we had a really good start to the year last year.
And that was the best part of the year, was the beginning, and we're only 15% off of that. So that's just something to keep in mind, is as we fall out through the rest of the year, we can expect that year-to-date percent change number of 15% to keep lowering, because we're going to have better legs throughout the end of this year than we did last year. Last year it fell off a cliff. We all know that. Q4 last year is probably the worst for anybody, for a long time.
Absolutely.
This year, we're going to have supply issues. We're going to have other issues, but people are still buying and selling, and we're adjusting to our interest rates.
Exactly. So let's give everyone some positive news. When you're working with buyers out there, the nice thing you can finally say is, hey, let's look at the last 12 months. Or let's look at our year-over-year numbers. We're starting to actually see price appreciation again, right? Because we went through those couple of months where, March, April, May, where we had those extreme swings. Mm-hmm. Those numbers looked super negative because they were just not what they were from a year ago, right? But it was really just a really short window. So now that we're in a position where, over the last 12 months, we've seen prices increase by $15,000 on average in Boulder County. Well, we're seeing some positive, more stable numbers.
And just to be clear, how we're coming up with this is we're not just pulling it out. If you look at that TTM change percent on the numbers on the bottom half next to my face, you can see how we're about even, if positive, in most of the areas. And that's a comparative of the last 12 months, which is when rates really shifted and the market felt it, compared to the previous 12 months, which was the hottest market that we've experienced in, I don't even know, ever. Probably the hottest market we've experienced. Those 12 months were the hottest 12 ever. So then you can see we're not dropping massive values. People aren't crazy underwater. Now, there's a few, if you bought in a, 1 or 2 month, about a 2 to 3 month period, you might still have to wait a couple years to really hit that number again. But outside of those folks in that one area, we're looking really good. This is a great sign for buyers.
Such good stability in this market, right?
And that's really what we
that's
say.
Exactly why the slide
is in Boulder, you pay the premium so you don't lose value.
Yeah, it's not Phoenix, right? It's not Las Vegas or Detroit, right? We're in a market where people buy here because
we can't expand.
They're resilient, they have wealth, because they're affluent and they make good decisions, right? And so there's a reason that this is a good time to buy for your buyers, right? So if you're working with buyers, reiterate this slide finally to them. I've been telling you to hold off for the last couple of months because it was much scarier than the reality, right? And now, year-over-year numbers, City of Boulder, we're showing about a 5% drop year over year, but the composition of sales have really kind of changed. The trailing 12-month data, though, plus 3%, we're right on target with what the Fed would like to see. Mm-hmm. So we're the anomaly, right? They've really crashed a lot of real estate markets, but the whole Front Range here in Colorado is much more resilient than most.
Well, and just put it in perspective,
Yeah.
we're capped on inventory, and if I wanted to go start a new project to go build, I probably couldn't even get single families approved, but if I just wanted to go build, 20 townhouses, that's a 3 to 4 year period.
Easily.
Minimum, if not 5 years. So we are constantly constrained by the supply, and that's across Boulder County. So that's when people are nervous about buying that house as a financial decision. It totally makes sense because it's only going to go up. We are a desirable place to live. Whereas, the emotional side, that's a little different. But as an empirical standpoint, it's a good time to buy. It's real estate in Boulder County, and there's a lot of value to be had out there.
Well, so Boulder's way different than the Denver market. Obviously, it's different than a lot of markets around here. But take a look at this. This one's pretty easy to digest. Combined, all of Boulder County, you can see month by month by month. July, we were almost back up to where we were a year ago. That's a really good sign. August is seeming, so far as it started, that we're actually seeing more under contracts than we were in July, which is pretty normal, right? Like because of the week of the 4th, things dip a little bit in July for total numbers. Yeah,
all that
but
good
with
stuff.
Kids getting back to school and everything, people will be out there shopping again. Usually see a really good, strong September too, and then we should way outperform Q4, right?
Really,
At least I keep
that.
banking on that because
Yeah.
we were down 35 to 45% in some months from the previous year, last December. So I think this is important to understand. We should make up some of that ground. We're going to end probably well over 10% down for the year, but honestly, we were off of some crazy numbers. So
Yeah.
I would say if you had to kind of compare this to a year in the past, think 2012, 2011.
Because we're all in the industry then.
Slow.
We weren't just leaving college at that time.
I was in the industry in 2012.
I know you.
I'm getting old. Either way, this is a good sign. Use this chart with your clients because it helps them understand some perspective. I think that's really important. Last slide that Tucker and I want to talk to you about, the percentage sold price to list price. It's slightly different from detached to attached, but it's all relatively the same.
Yeah, so let's first just start on the detached. As a market as a whole in Boulder County, we're just under 99%. That is trending towards a little bit more balance, but it's still leaning seller. If it was a sliding scale, we're still leaning seller.
We're not leaning. It is a seller's market.
Yeah, I say
100% list to sale price means it's a seller's market. You're getting what you're asking for. Now, the big
but
thing
we don't
here
see
is
the concessions.
you don't
in
see
this,
the concessions.
and that's why I say leaning. So
Look
I
at
say
this.
leaning.
If you're still paying attention to this video, here's your nugget of wisdom. 39% of all homes that sold last month had concessions. Thanks for waiting 17 minutes for this.
Yeah, that's the best piece. Thanks. See you later.
Yeah, no, exactly. But either way,
Yeah.
it does look pretty normal, right? We're normalizing in our seasonality for the Front Range here, but what you're seeing is you're not seeing those concessions. So
Yeah.
it looks great on paper. It's probably not quite as good as it looks. It actually is a much tougher market. But for buyers, take your buyers out there, give them that information. They can go out if they ask for asking
And
price.
this is something too.
Get
Is
your concessions.
get your concessions. We've seen appraisals. As I'm sure you all are seeing out there as lenders, appraisals are coming back pretty good.
Oh yeah.
Like we have not been hearing of a lot of appraisal issues. So that's where you can go. Hey, let's raise the price 10K. Give us a 10K credit. Awesome. And also one thing I want to point out here is let's look at that 1.5 to really all the way up to 3 million. Those are softer areas of the market. That is where you can find value. You can see those percentages.
2.5 to 3 million range.
91% buy.
Man, that is a buyer's
That
market.
is buy right now. And even that 1 million to 2 million, that is normally one of the strongest segments. And the fact that it's at 97.5, yeah, that's still leaning seller. But with the concessions and everything else, this is a value time to buy.
So think 95% is your balanced market range, right? At least when it's on paper. But without the concessions, that 97% is probably much more closer to balance.
Yeah.
Take a look at this in attached because attached is very different than the detached market. We got a really strong attached market in Boulder County. It's not necessarily that way along the Front Range, right? It's very much so here. Money's coming in, but look at that. Even 600,000 to 800,000 over asking price offers. The couple of homes that sold 1.5 to 2 million. Bidding wars. They were awesome. They're pretty new stuff, right? I mean, that's kind of what you see in Boulder County.
And let's remember, attached really took a backseat for a lot of the first two and a half years of COVID.
Sure.
So they're making up ground. So we can expect
the
them.
value there has been so much better this year.
Yes,
Right?
and that's where we're coming back to this value word. Is you want to live in Boulder, you want the location, you want the schools, you want all those good
But
things.
you don't want to pay $10,000 a month.
Yes. Well, here's your option. Go buy a
right.
condo for
Or even a nice
500,000 or a
townhouse,
townhouse
right?
for 700,000.
Exactly.
You know, that is just where we're seeing this come through, and we're just seeing demand as well. And you know, this is anecdotal, but I've been hearing rents are doing really well. You know, people were nervous about rents falling. Remember, when the market's slow, rents go up. When the market's hot, rents go down because
Yeah,
people
so
are
the
buying.
nice thing about this is that's actually going to put some pressure on some of these renters. It might be time to hit up your renters again, get those first-time home buyers back engaged, because if they can compete now, especially in Q3, Q4, if things get hot in the springtime, they're just going to be priced out of the market,
Yeah,
right?
it's
And so
hard.
this is a really good time for your first-time home buyers. We're seeing a lot of them. They can compete. They can negotiate for those rate buy downs to help qualify and everything
This is something too, is keep reminding your agents of the programs you have.
Yep.
Because there's so many great tools that you offer. Go show the agents, talk to them, tell them why, and then help them see how valuable this is to get their clients, you know, back into the market to start shopping.
Absolutely.
Okay.
Well, thank you for joining us today. We will catch you next month. If you have any questions or you need any local market data, reach out to Tucker or myself. We're always happy to see you. So we'll catch you soon.
Talk to you next month.
Bye.